So I wanted to start by talking about why the market's dropping. So have you all read into it at all? Do you know why the market's dropping? I'm sure you do.
Not really. I just read like one article. It was like fears of inflation.
Yeah. Do you know where that fear is coming from?
Probably QE 1, 2, 3, 4, right? On money printing.
There was some economic news released around this time. And I'm not sure how we guess when. What?
Higher interest rates.
No, it was right after that. So they had a federal funds meeting, and then like a day or two later, they had an inflation measurement come out. It was talking about basically the wage growth. And so wage growth, we've started to see a tightening of labor markets. So you're an economics major. Do you want to talk a little bit? Do you know too much about it? Or do you want
really,
to talk about
the only thing I've really seen is that like the yield curves slowly steepening because I mean they have to keep raising rates this year,
Right.
and it would have been a better time to raise rates. I don't think last year with the market going up so much.
Right.
But I think it's just inevitable to raise rates, and then I think that's kind of having a little bit of an effect on the markets right now.
Right.
And then if you look back until I want to say it was like midway through last year, the 10-year was at like 2.65, and that's where we saw like a last little bit of consolidation. Let's see, I want to say it was like in between May and July, right there on the SPY, but you saw a little bit of consolidation, and the yield started coming down again, and the market picked back up. So we've seen another interest rate hike, and then there's talk about 3 more this year, as long as the new Fed chief stays kind of on the, Powell. As long as Powell keeps on the current plan, interest rates should keep rising, but it's really a good thing though.
Right, so what he's talking about, this is the 10-year note, and this is the past 3 months, right? So we can go even to the past 5 days, right? Because that's whenever kind of the market has started selling off, right? So I wanted us to look at the 10-year. This is the past 5 days, so you can kind of see a low of 2.7, and now it's at 2.8. These are massive moves. If you really think about it in something like bonds. Like this is the 1-month bond yield, so it's gone from 2.4 to 2.8. So what do you think is driving these bonds to move higher? Yes, it's interest rates at some point, but I think it's the inflation fears that are going on. So I'm sure you keep up with economic news, and I'll try to teach y'all, and we're going to cover the basics of this in general meetings. So one analysis that you can use is economic news, right? So these are all the economic data that has been released through the 31st to today, right? And so the one that kind of caught people's attention was, I think, this one on February 2nd. And you see all these red ones right here. The average hourly earnings spiked. So they were expecting only 0.2% increase, and it went to 0.3. I read something, I don't remember exactly the year, but it was like since 2008 or 7, this was the biggest increase in hourly earnings that they've seen. So why do you think that spiked the fear of inflation? Do you have any idea? So I'll give you an idea. So our unemployment rate is really low right now. It's almost unnaturally low. So what happens is, as the labor market starts to tighten, you see employers have to offer more money, higher wages to keep or incentivize new workers because there's so much competition for workers. So this is kind of an early step of inflation measurements, the average hourly earnings, right? So if the wages are growing, then you expect those people to have more income, right? And then they're probably going to spend more. Therefore, that's where the theory of inflation comes from. So inflation is massive because right now what I'm seeing is fear in the market that inflation is probably, it looks like investors are freaking out about inflation through the tax bill and through tightening labor markets. And what they're scared of is that inflation is going to start running wild and that the Fed's going to have to start raising rates more than they would have to in the normal economy, more than maybe 3 times a year, 4 times a year. So they start seeing that as a negative instead of a positive. Because, like you said, it's been on the track for normalization with Yellen for, this was her last meeting. Now it's going to be Powell, but it's been on the path for normalization for a while. They've always been saying it, but this is different to me because there's some fear, and that's what inflation also drives up the bonds. So you'll see the longer the bonds, the more sensitive it is to inflation. So let me see if I can look at 30-year bonds. So same thing. This is the 30-year bond. So the 30-year bond has gone from 2.8 to over 3. So these are massive moves, and that's based on inflation, right? I don't want to get too into economics. I'll spread all this out, but I'll talk about why these bonds are moving maybe next week and why they're moving based off of inflation. But I thought that was really interesting. I think that's honestly what's going on in the market.
Can you go to a year-to-date chart of that 30-year?
Yeah.
I want to see.
So it's gone from about 2.7 to 3.
Actually, the 1 year I was.
Oh, sorry.
Look at. So I mean, so like this past year, we've seen several spikes of kind of the yield curve just running up,
Right.
but every time it slowly comes back a little bit more and then run up even higher.
Right.
I think at some point we just have to ask, where is it going to top out, and when it starts pulling back, because then when it starts pulling back, then you're going to see the market run back up to where its highs were at, I think,
Right.
because that's kind of what we saw earlier this year.
Right. So technical analysis can be used on any charts, including bonds. So I think it's really interesting that the bond market has kind of consolidated in this area. In this area right here. Let's see,
That top back there in 2017,
right here.
that one,
This was in 2014.
2014.
Yeah. So it's kind of interesting to see how. I wonder what caused this right here. This was the financial crisis. Yeah.
And then we've had artificially
So
low interest rates.
if you look at it that way, the yields are just moving where 08 started to happen. I mean, they're just starting to be back at that point, which is kind of interesting. But anyway, so what I wanted to do today is look at indexes and try to find good buying opportunities or where we think the market might find some support, maybe stop dropping or consolidate. So this is the S&P. This was my stop loss. Thank God I got out. And then I just wanted to see if y'all see anything, my technicians, on this chart. Do you want me to go to a higher time frame? Tell me what you want to look at. Zoom in.
Just real quick, that was a trailing stop loss, or?
This was, it wasn't a trailing stop loss. I used regular stop losses.
Okay.
So I move them up as my trades go into profit. So I don't actually have a take profit, if you would. I just get stopped out in profit, if that makes sense.
You manually changed it.
I manually change the numbers because I look at stocks every day. So we talked about this a little bit. If you don't want to do that, then you should look into something like a trailing stop loss. And you should also look at the volatility of the stock and take that into account when you're setting your trailing stop loss. So for instance, like if you were looking at something like, we were looking at Tesla earlier, right? This stock likes to really move. I mean, it dropped 8% today, right? So you're not going to want to place your trailing stop loss with the same percentage as you would on another stock, maybe like the S&P, right? Because this one moved 8% today, and you see these massive moves. So just take in consideration how the stock moves naturally whenever you're doing your trailing stop losses. That's what you choose. So I wanted to look at the S&P, the Russell 2000, and then maybe the NASDAQ and see what y'all thought. And then I'll give you a little insight on how I look for trading opportunities. So this is the S&P. Y'all see anything here? You see anything kind of interesting?
Yeah.
What?
Super bullish trend.
Super bullish trend, right? Like I've got this kind of like upper channel, and it actually started breaking out at the beginning of the new year, which was kind of interesting. I think people started to wait for tax reasons to start adding money until the beginning of the year, because the tax bill got passed around here. And so it was kind of weird that you didn't see this initial spike up right at whenever we saw the tax bill pass. The market kind of just sat there for a while. But right whenever the new year started, almost like clockwork, right here. You see that? This was the new year because of new tax season, right? And then you just saw this massive run up in stocks, which I thought was kind of interesting. So it ran up 6.5%. I bought in right at the new year whenever I started seeing this movement. So
What about around last year, New Year's?
last year,
New
there
Year's
was,
previous, yeah.
Can you close the buy sell?
oh yeah, here I can move that up. There you go. Is that better? So last year would be right around here, and you see almost the same type of thing. This was the month of December, and you can see it kind of just consolidated.
Yeah.
And then the new year started, and it started almost a bull run, if you would. It's re-continued the trend after the new year. So I think part of that, I can't tell you for sure, but that's the reasoning, and that kind of makes sense to me, why people would wait for the new year to start putting in money, or moving money around. A lot of times you'll see people sell or just reorganize their portfolio. What's that called? I forget the exact name.
Reallocate?
Reallocate their portfolio. Thank you. I think they just wait until a new tax season to start doing that. So you see a bullish trend. Does it still look bullish to you? Does anything stand out, make you troubled as a technical trader?
I mean,
The dip right here, right?
It's a pretty significant dip.
Yeah, it's pretty nasty to be honest. Yeah, definitely. These massive candles, right?
But also you said at the new year, like it starts running up a lot faster than what it has been throughout the previous year.
Right, it's a lot steeper. Yeah, that's a really good point because in a month it was up 8%, right? Or around there?
6.
Yep, 6.5.
6 or 7%, right?
Oh, wow.
So, I mean, that's in a month, and this is the whole market. This is an ETF, right? This isn't an individual stock. So, yeah, you're totally right. It's a lot steeper here than it was right around here, right? It kind of just took its time. So, yeah, it's really interesting that these massive candles, we haven't seen moves like this. Yeah, this was the last time that I actually shorted this. This was whenever Yellen,
Raised for the first time.
for the first time, and said that they were going to do normalization. They actually, the investors threw a fit almost, and you saw this massive sell-off here. This was, I think she announced right around here that she was going to start normalizing rates. And so it's really interesting that we hadn't seen moves like this or candlesticks like this since 2015.
There's been no volatility in the market.
No, as you can see, it's these very nice shorts, almost orderly buying of stocks, right? You don't see these massive candles like this anymore, right here, right? So like for the past 2 or 3 years, it's just been these nice little moves, maybe a spike down here and there. I think this was maybe Brexit, right? Yeah, during the summer of 06. And that was the only time, and then other than that, it's been very stable. So, are you all kind of worried about the increase in volatility at all? No?
It's probably a good thing, really.
I like
Right.
I like trading. Relatively.
Right.
As traders.
Right, definitely.
I'm looking for an entry.
So why do y'all feel so comfortable even though the market's down 10%
It's
in the past week?
It's been due for 2 years to have some sort of direction. We haven't seen anything since, like we just talked about. You know, I mean, you see some parts on that line where it consolidates, but
Right,
most of the consolidations over the past year and a half have been almost positive consolidations. you know?
right.
So I think we're just due for this.
Yeah, definitely. I definitely agree with you. So I think that a market sell-off is really good. I read an interesting statistic. You should always have facts to back up your things. You don't ever want to trade off of emotion. That's how a lot of people get in trouble. I'm not saying that any of y'all are doing that. But one part that makes me think that the market's still going to go up this year is that I read an interesting statistic about the S&P earnings. Like 80%, I think it was, of all the companies beat their expected earnings the past year. 80%. That's incredible. Out of 500 of the largest companies, they all beat earnings. The only question that I kind of have is how are analysts putting in the tax cut, right? So was it a one-time kind of deal, right? Because the analysts couldn't have put it in for December when they got those massive cuts. So do you think that the tax cuts kind of going to be a short run, kind of like this? That was kind of it, as analysts start understanding that the new taxes are just a one-time hit, or do you think it's going to be a constant driver for the rest of the year? That's the only thing that I've constantly, I mean, I don't think there's a right answer, but that's the question I've been kind of asking myself, is that are analysts already pricing it in as normal, if that makes sense, for the tax cuts, because it happened in December. So now the estimates are going to be revised up anyway, if that makes sense. Most analysts are expecting the stock market to move, I think, 10 to 15% this year. I think that's pretty interesting.
Almost 7% in January, so.
Right, right. Well, I mean, the year just started, so we could see a consolidation or a sell-off for the first month or 2 or 3 months of the year, right? Consolidation and then maybe pick up mid to late year, which would kind of be normal, I think.
It's good,
Yeah.
it's healthy.
We just had earnings, so maybe the next driver, maybe the next time that we should really look heavily at indexes and things like that is maybe around the next earnings cycle, maybe next quarter. So yeah, I agree with y'all. I'm still positive on stocks, but do you see any levels that kind of stick out to y'all? Maybe where the market might catch some support or maybe bounce off of?
We might be at some support right here. If you look at like all the lows from November of 16, not that very bottom low. Well, that's like over. All right. Well, I guess you could draw a line from that exact bottom in 16 all the way to the bottom right now, and so the chart should touch that line about 3 times.
I see exactly what you're talking about.
Well, yeah, right there. Maybe a little higher.
It's this day right here. I mean, I can get to a weekly if you wanted to. That might help out a little bit.
It's a little bit better. But like if you have that top line and the bottom line,
So
if
you're saying
they're
right here.
like parallel to each other, that should be kind of the range it traded in. And in January, it spiked over that range, and that happens from time to time. If it does, then you should see a pullback like we've seen.
So you're saying that it might catch some support here at this trend line.
Right, and if I'm not mistaken, I think the 200 days near that trend line looks like the 200 days. I think 30 or 40 points below where the S&P is at right now. So
Okay, so around
3
here.
or 4, yeah.
Okay.
And it doesn't mean it's going to come back from that, but it might draw down a little bit below that line, consolidate.
Right.
I think 6 months, maybe we're back.
Okay. So that's an interesting perspective. So if it broke the 200-day, would you be worried about the market? Would you be
Yeah.
expecting a sell-off?
Well, I mean, if you break the 200 day and you see another 1,000-point decline, then we're entering like bull market territory from there,
Yeah.
and that's where it's worrisome. But I mean, all the fundamentals are there,
Right.
so I don't think that's going to happen.
Right.
I mean, everyone's raising expectations, raising guidance, beating earnings. I don't see anything that's like, oh, everything's overvalued. I mean, the PE for the S&P is at like 25,
I
which
don't know exactly what it's at, but yeah.
it's like
somewhere around
high average range, but it's
Uh-huh.
not like at a high point yet. And we haven't
Right.
seen. I think we're fine.
Yeah.
There's just a lot of things like fundamentally
there. Right.
that point positive for markets right now.
Yeah, it's definitely going to be interesting. Do y'all see anything else in the charts? Anything else kind of sticking out to you? This could be a good level to watch. You know, third bounce would definitely be a good time to kind of watch the market. Maybe see how it does tomorrow, right? Because if it has kind of like the past couple trading days, it might drop down in this range. This is only maybe 1% or 2 off. Yeah, from that from those levels. So, anything else y'all see? The next support resistance level I see is right here, which is, you know, another 10% sell off, I'm guessing. 18% sell off. I mean, you're starting to get into a really, really iffy range. So now I want to look at the Fibonacci levels. Do y'all know a little bit about Fibonacci's? Okay, so Fibonacci's, I'll just give a quick oversight. These are based off of mathematical formulas added up, and these patterns occur all throughout nature, right? So If you look at the way that galaxies spiral, right, it's actually a Fibonacci ratio. If you look at parts of your ear or parts of like your hand to certain ratios of your body in nature, even seashells, the way that they curve around, they all have these Fibonacci ratios. So it's kind of interesting that these ratios also work in the stock markets. So real quick, the 38.2 is still a bullish trend. So this could be kind of what we were talking about. If it bounced off the 38.2 retracement, that's still a very bullish sign, right? Once when you start getting to the 0.5 or the 61.8, you're starting to look in for a good, maybe it's oversold, definitely oversold at the 61.8 levels. These are the highest risk to reward ratio trading. Some people just make money off of using Fibonacci's and trading these 61.8 retracements. It's really interesting. I love whenever you start getting key levels and different analyses starting to line up, right? So we were just talking about the support resistance level, and maybe a percent or two away is the 61.8, right? So if the market, I'm not saying it will, but if the market started selling off around here, I would definitely take a bet. I would take the odds that the market's probably going to bounce from these levels around here. I'm not saying it's going to drop 18%. I really hope it doesn't. But this is definitely an area that I would watch out for if it starts to really fall. That I could maybe see it finding some support or resistance. We could also do Fibonacci clusters. I think if we started doing clusters, that's basically a cluster is just starting it at different points, and you can do, from a different low or high like this, and where key levels start to line up, right? So right here you have a 0.5 and a 61.8 right next to each other. This could be a key level, right? Where you have this, you can do it over and over, and the higher ratio cluster there is, the higher percentage chance that they're going to bounce. So that's something really cool to look at. So far, the S&P doesn't really look like it's in too much trouble, just kind of a small sell-off.
It's a healthy correction.
A little correction as of right now. I mean, 7 or 8% is kind of crazy looking back, and it's freaking a lot of people out. I don't know if you have seen the headlines. People are like, stock market's going to drop, and everybody's pulling their money out. They just don't understand that it's normal for markets to run, drop a little bit, consolidate, and then move again. Right? It's just like an athlete, right? If you're running a marathon, before you go for your next marathon, you've got to take a break. Stocks kind of have the same
Can't run forever.
philosophy. Exactly, right? So that's a good way of thinking about it. A lot of people just expect them to go into a straight line. So yeah, let's look at, what was it? This is the Russell 2000. So in the past 2 weeks, it's dropped 10% also. This is the daily chart. Also wanted to point out there's a candlestick pattern that's kind of troublesome, and it shows up on all of the ETFs. And it's this right here. I don't know if you see it, it's this massive green candle, this little wick right here, and then a massive, this is actually an evening star. So I'll pull that up. Right, so this is an evening star pattern. Do you see that right there? It's a green candle, kind of this small, indecisive candle, and then a massive decline. So this is a bearish sign. This is a candlestick pattern saying that this is a bearish sign. And then you also have these engulfing bearish signs. So the candlesticks, from my perspective, are saying that this is probably going to start dropping a little bit more. We'd expect a little bit more decline in the time coming. Like I said, it's not 100% accurate, but that's what I'm seeing from a candlestick point of view. Same kind of thing. I see some support resistance in these levels right around here. So this one looks like it could catch support a little bit sooner, 5 or 6%. Especially at these levels, this is a really strong support resistance. I don't know if y'all see this. This is a really good risk to reward ratio type of area right in here. Because you've got 1, 2, 3, 4, 5, 6, 7, 8, 9 bounces in a small area spanning less than
That's
a
the
percent.
daily?
What's up?
It's the daily chart.
This is the daily chart. So you're seeing 9 bounces in an area of 1%. That's insane. This is a really strong support or resistance level. So The candlesticks are telling me it's going to drop more. You can mark it up, and some people are going to buy in over here, but I look for the highest risk to reward ratios. If it drops around this level, I would definitely be a buyer. And then my stop loss would go a little bit below here at some range. And then that's what you kind of want to look for. If you're not a technical trader, you should definitely brush up and train your eye to see at least support and resistance levels, because those are going to give you a good buying opportunity and tight management, risk management. So for instance, if it's right around here, you know historically or price action wise that the stock is less likely, and you can put your less likely to break down at these levels. So you can minimize your risk by finding these levels and kind of placing it here, right? So if it comes down here, you can risk 3% of your portfolio and have a really good chance that the stock's going to bounce at these levels. Any other ones that y'all want to look at? Yeah? Okay, so then I'll pull up the sector ETFs. I usually do the spiders. Did y'all see the markup that I posted of XLP? Right, so it's this really nice long channel that's been running for 8 years, gaining constant 22% per year, has a dividend of 2.8% or somewhere around there. And it had some interesting price action, and this lets me know that my markup's right, but the trade is in trouble. Right here, it closed or opened down on this level right here. It literally tested on the open the trend line from 8 years ago. And you saw the price action take up. Buyers on an ETF, this rose 3% in a day right here, but it's got even a worse evening star pattern right here. So it's kind of concerning. My stop loss is below this trend line, of course. So we'll see. It's a percent or two away. I mean, I'll either sell out tomorrow, it's going to probably bounce. One of those two. So just, if you get into trades, make sure that you have stop losses set to keep your emotions out of these trades. So my trading strategy, I'm going to kind of tell y'all what I do. I look at ETFs of sectors, and then I mark up the ETFs. Now there's all different types of ETFs. For instance, that's why I was pulling this up, right? So you have one for energy, you have one for utilities, you have one for technology, materials, staples, discretionary, industrial, healthcare, financials, real estate, right? And they're all the ETFs are comprised of different stocks that have different weights. So I like spiders. You can look at any ETFs, they're all good. All their charts are going to look completely different on some of them. But I like to look at least once a month or once every couple of weeks. I like to look at all the sector ETFs to try to see if I can see a specific sector that's going to overperform or underperform or just like the chart overall. That way you can be diversified and that you can kind of look at what the market's telling you, right? So the S&P is comprised of all of these. It's comprised of all these different sectors. So if you want to start becoming an active trader, you should start looking at specific sectors. So for instance, I'm extremely overweight financials, for instance. So this is how you start becoming an active trader is you go from the S&P and just start narrowing it down, right? So if you're an active trader, you might start investing in these ETFs, for instance, like the financial ETFs. And as you become more knowledgeable or spend more time, then you can go into individual stocks. But these ETFs are great because they're getting closer to stocks, but they still have the diversification of an ETF. So I think the XLF is okay. I'm 50% in cash as of right now. I took profits in URI. I can show you that markup. Like I said, all of the stock charts are doing this really interesting pattern. So keep an eye out for the next couple of days and just kind of see what the candlesticks are telling you. So yeah, these stocks look okay. I mean, they're probably let me do a quick Fibonacci. Yeah, they're a little bit. They're around the 38.2, and I could definitely see them going at least to a 50 or 61.8 retracement. So that's only probably 5% drop. Right? Yeah. So that's it for me. I'll show you the trade that I took profit in. I bought this after Hurricane Harvey, after it was like $1 trillion infrastructure bill was passed. I bought it down here. I was up massive in the trade. It was one of my biggest positions, around 40 or 50% of my portfolio. And I started adding in at different points. And this was the last little sector. And my stop loss was a little bit below this. So I got triggered out of that earlier in the week. And I took profits out of this trade. So the only ones that I currently hold is Bank of America and the Staples ETF, which I might sell out of next day or two. Are y'all holding any stocks, or what are y'all holding? Pretty much everything.
Lockheed Martin, that's like one of my favorite ones.
Do you wanna pull it up?
Yeah, sure.
Yeah, for a little bit.
They've increased their dividend a lot in the past like 3 or 4 years too.
Yeah, they have a great balance sheet. Great stock. Alright. Let's see. I mean, I actually went back through like all the different sectors. If you look at the defense sector versus the market itself, past 3 years, 5 years, and 10 years, it's beat the market crazy. It's like a crazy amount between like the difference between the two. But if you look at this, like this chart in general, it's obviously like a bull shape. But the fundamentals are great with this company. This year alone, I think the budget is supposed to be, they haven't gotten that budget thing passed yet, but it's supposed to be like 80 billion, I'm pretty sure, for this year and next year. And that's going to be increases versus, it was like 20 billion for the defense sector in general. So the defense sector is great. And then Lockheed Martin does most of the contracts for the United States. If you look at the chart, we've seen it top out at 360 after it had this huge earnings run like right in here. All those candlesticks.
Looks like they almost took profit after earnings.
Yeah. Well, let's see what earnings were at. I'm pretty sure
Earnings were before that run up.
Right.
Yeah.
And they killed earnings here. Where is it last week? They had earnings back
That's
here.
on the
where they
1
missed.
hour.
Was that?
That's on the 1 hour chart.
Oh, it is?
Yeah.
Not familiar with this. Do you know how to add the like moving day averages and everything?
Let me see. I might have too much on my charts. I can see because I got like the free version.
Right.
I'm trying to save. Some other moving averages. Yeah,
Right.
they're not going to
Right click in the background.
You're saying I have too much stuff on my charts already.
It's not like an insert indicator.
Yeah.
Stock charts.
Yeah. You can pull it up right there.
See, I used to use finance.yahoo, and they recently took off, like, you can't go across, like on normal charts, if you put your cursor over it, it'll show you like the dollar amount and the date on there. And they took that off, and I don't know why.
Really?
Yeah. At least on my computer, hopefully. Let's see. That's not Alright, there we go. Alright, so if you look at like all the defense stocks in general, if you looked at Boeing, Raytheon, Lockheed Martin, some of the other ones, you see all their stock charts, they've all been trading above the 50-day, even with this recent decline. especially after earnings. But if you look at any of the other sectors that I've looked at, like financials or generally just the stock market itself, everything's traded below the 50-day. So it's a really good sign for that sector. The defense sector is supposed to be safe anyway, but I've actually seen it to be like a higher growthing sector versus anything else. I mean, really what I've seen is like Lockheed. I bought in, let's see, 289, yeah, right in here last year. And if you look at Boeing even versus that, Boeing's going to be better, I think. Yeah, Boeing's had a huge run up too, but you haven't seen that same kind of run up from Lockheed, which is surprising because they do most of the contracts for the United States anyway. But
Boeing started taking off after Trump got in office and was
Right.
looking to upgrade or something like that, right? That's
I
when it
mean,
started its run.
yeah, Boeing started its run. I mean, Trump, like right when he first got in office, with Boeing, like what he did was he went to like several different plants for Boeing. He did speeches and everything, generated some kind of like upward trend for them. But then they've also started like stealing contracts from people like Lockheed and stuff like that. But Lockheed still has like I want to say it's 9.8% of like all the defense contracts for the U.S. And with a Republican in office, it's only going to go up from here. Even if you look at like a 5-year for both of these stocks, like when Obama was in office, which a Democratic president is typically not great for the defense sector because they want to be more towards cutting spending for that. But both these stocks still did a really good job here. Finally, put it up. So 5 years, Boeing's gone up 350%, Lockheed Martin up 280%, and they're all pretty much. Pretty sure they're relatively cheap. I want to say, not that cheap. So 48. 48 is pretty high for PE, especially for defense stocks. So might see a little bit more of a pullback from here because both of these stocks really haven't pulled back at all compared to someone like Apple, which a lot of people.
Yeah.
Apple's cheaper though. I mean, Apple's only 16 PE.
Right.
I'm not really a fan of Apple since like what they've done with the iPhone. They've sold less this year, but they've had an increase in revenue. So I guess maybe that plan's actually working out for them. But Apple's right now coming down through its 50-day, so that's not a good sign for them. All their supports, let's see, the top out there. Does anybody else see any support on this chart for them?
Nope. Not really. Well, you have to go to candlesticks. It's kind of hard for line charts. Here it's right next to draw,
Was it like 127 maybe? Yeah.
and then go to candle.
Yeah, I was thinking
127?
25,
Yeah, that's
Right here.
Or
Yeah.
was that 132?
It's got like a good 3 or 4 top right there. Yeah, 3 or 4 tests.
Let's say 4. But mostly like my kind of analysis for stocks, I mean, where I look at everything is like the 50-day, the 200-day. So if you look at the Dow, this is what I've seen is that looking at the Dow in the past year, it dropped through the 50-day, it tried to recover through it, and it retested and obviously couldn't break through it there, and it came down more. So I'm thinking it's going to come down to the 200-day from here.
Yeah.
And then the Nasdaq's done the same thing.
And so people who don't know anything about simple moving averages, the 50 to 200 day, you can do crossovers as a buy and exit strategy. So for instance, right there, where the 50-day started to break through the 200, that would be a buy and crossover. It's called a golden cross. And also the simple moving averages almost act as a support resistance line sometimes. That's what he was talking about, breaking the 50-day, right? You can see sometimes it will find support at these points. So for instance, here, can you scroll over a little bit more?
Is that right?
Yeah, so for instance, like right here, you see it kind of bounce off this 50-day. Same thing right here, right? So that's what he was talking about on the 50. These are simple moving averages crossover. Usually the 3 main one is 50, 100, and 200. And so you can use any mix that you want. But that's very common for technical analysis.
I want to say though, like, if you look back in here, you saw it test the 50-day, came back up through it, again tested the 50-day, came back up, touched the 50-day. We haven't seen it touch the 50-day since September. So I think that's a pretty healthy sign for come back down through it. Even if it comes through it, you still have some support at the 150. I don't think the 150's it's definitely not as strong as the 200 day, but it is another level of support for that. So let's take a look at that. Yeah, so 66.83 for NASDAQ. And really, I mean, you're only looking at like another 200 points.
Yeah, that's
We've
kind of
seen-
the range that we were looking at using different technical indicators.
Right.
So,
I mean, when you looked at the Fibonacci, like S&P,
right.
I'm pretty sure one of those lines lined up with the 200 day.
Yeah, usually you'll see overlaps in technical. A lot of technical buyers will have the same buying range.
Right.
So,
And I think most of kind of the market movements recently have been from technicals just because of the algorithms control 81% of the market, I think. I don't know, you might have said it was a different figure.
it's like 95 of current, 90 something of like current volume the stock
Right.
market's done through. I don't know the exact number, but that's volume. It's like 90 something percent.
So it's very high. Really what algorithms use is volume and technicals, so Fibonacci's 200-day moving averages for up to 50 days. Did you look into that thing? It was kind of like I forget what it was called. It was like a bubble indicator, whatever it was. It was
Oh, the one that used all the different. It's
like it was like a 10-day moving average, a 20-day.
yeah, that one was really interesting. Oh, I forgot the name of it. It's not the MACD.
Well, that one I thought was interesting because, like, I mean, you'll see it's more of like a trading by the hour type of thing.
It was I can't remember the name right. Oh, it was G. It started with a G.
Guppy, was it?
Gubby, something like that. But what it did is it combined like 20 different simple moving averages, right? So it would have the ones for short-term investors and in one color, and it would have all the simple moving averages that a normal short-term investor would use. And then it would have one for long-term investors, right? So the long-term investment ones would have long-term support, resistance, or buying opportunities. And it would include things like the 200-day moving average, the 150-day moving average, the 100-day moving average, right? Those are longer-term trends. And then you'd have something like the 15-day or the 50-day and the 25-day for short-term. I can try to find it, and I can post it in the group if y'all are interested. It was really interesting to me.
Yeah, it's interesting for sure.
Yeah.
But if you look at this here, obviously, like the smaller day moving averages move a lot more quickly because they pretty much just follow the past 20 days of trading. That's what moving averages are. But if you look at like 20-day stays above these moving averages, and it's only really a negative sign when you start to see this cross through, and then you'll see the 50-day come through like the 200-day. And that would be, it's the opposite of golden cross. I forgot what black cross or whatever, I don't know what they call it.
Death cross or something.
Death cross,
Yeah.
yeah. Something scary. But yeah, I mean, it trades along the 20-day, and it stayed above. I want to say, yeah, it stayed above the 50-day for a while when it got past September,
Right.
but it hasn't touched. What is that? The 150-day or the 100-day? It hasn't touched the 100-day since. Let's see what that is. The last time it touched the 100-day was back when Trump got elected, like a month or the same time actually. The day he got elected, it touched the 100-day. It hasn't touched it since. And today it touched the 100-day, fell through it, or touched the 100-day 2 days ago, fell through it today. So obviously that's not going to be support for it. So then you look to the 150, and then I think the 200 is probably going to be one of the better levels of support for this. But that's really my opinion on markets. I mean, I don't see it really going down to 500. I mean, I remember back in like 2015 when the market was at like 5,000, everyone was, oh, we need to pull back, and it's always kind of the same type of thing. It's like when it pulls back and it gathers some support, just slowly buy on the way down, and that's really the best way to get into the market. That's really actually.
So I think me and you have the kind of similar trading strategies is that we're both economics majors. So the way I use my economic knowledge or degree is that I can understand economic news, so I can understand, I think to a good point, whether the market should be bullish or bearish. That's the first step, and I think that's what economics plays a big role for me is understanding just the general market like direction of the market, right?
Right.
And then using technicals for buy-ins or trading, right? So I think me and you have very similar trading strategies in that way.
I would agree with that.
Yeah.
For sure. What I like to basically look at is most people want to look at kind of a mix between fundamentals and technicals, and I know you kind of focus in on that kind of too. I don't know if y'all saw Twitter just beat earnings for the first time, or not beat, but they had a profitable quarter for the first time ever, and they jumped 30%. So that's good. Snapchat, they beat earnings. They started to.
Did you see the new update? Do you think it's gonna kill it?
On Snapchat or
Yeah.
Twitter? No,
Snapchat.
I haven't updated either of those yet.
Yeah, I heard a lot of people hate it. Yeah.
What is it?
Because they're trying to redesign it to get people to spend more time on it.
Yeah,
Right.
trying to
So-
boost advertising and everything.
Right. I saw that they started producing. Did y'all see the Snapchat store? Sorry to go on a rant. They're now creating merchandise like shirts, hats,
I know they did the glasses. That was
glasses.
funny.
Yeah.
Did y'all see the
Yeah, I don't
They
think
had
it's
glasses
basically
with the
dropped
glasses.
since its IPO. I don't think it's gained
Oh,
since
really?
then. Yeah. SNAP.
It's up 30%, I think, the past 2 days. Yeah, right here.
Yeah. Did it have earnings or something?
Yeah.
Too.
But I mean, the one thing I've seen with this, and the reason why I've kind of just sat by, I'm not in Snapchat, but I think it could be a future buy really, because when Facebook had their IPO 2 years ago, everyone doubted that, and everyone hated it. It was like, how is this just strictly social media stock actually going to make money? And what they did was they figured out the advertising behind everything, and that's what Snapchat's biggest worry was. And they've slowly figured that out. On the conference call, I think Siegel, whatever his name is, I think it's Siegel, he said that all the ads are now bought programmatically, like at Facebook, and that's something that they think is really going to help them. So kind of interested to see what happens there. But this is Facebook's IPO back in 2012.
Vance, you could probably talk about, since you're an advertising guy, Facebook and their advertising. Advertising. I see a lot of ads, and I see businesses pouring into social media a lot more than TV ads now. Like they're now.
Yeah,
starting to
it's
advertise on
actually
Facebook.
TV last year. TV ad spending was about, I want to say it was between 74 and 75 billion. And digital advertising surpassed that by 2 or 3 billion. So now digital advertising actually surpasses traditional forms of marketing. Now with that being said, with I noticed, the recent changes to Snapchat, like the advertising on there, the Instagram, it's definitely changing all of them in the sense that you can now reach more people, reach bigger audiences, and with more businesses and more, all these Fortune 500 companies especially, they're really targeting those. It affects it in the sense that once you kind of flood that space so much, now Facebook wants something new that can, I guess, gain more of the market share. Like, okay, now most of Fortune 500 companies are using this, but how can we get more of this market? And then that's when Snapchat realized, okay, I didn't even think you could do ads on Snapchat until after I watched somebody's story. I figured out. I don't know how they did that, but
So, sorry to cut you off. What do
No,
you
no,
think
you're
is
good.
the best platform for advertising? Because most of these social
Facebook.
media,
Facebook.
right? I would definitely agree with you. Because most of these social media platforms, right, the revenues are solely driven on acquisitions and advertising most of the time, right?
I want to say when I was, because I work a lot in the industry, 22% of the world uses Facebook, and
That's
that's like 2 point. It's a few billion people.
Right.
Yeah.
Yeah.
Compare that to Twitter
Yeah.
and Snapchat.
Right.
But then some would say, well, they have more market share to gain, I guess, But Facebook's been around, how many, 10 years now, or 12 years?
Something like
Right.
Whatever it's been. I mean, it's obviously been a steady player in that industry. And I think what's interesting to see is if you look at CBS's earnings, Fox's earnings over the past year, 2 years, Netflix, Facebook, Amazon, Google, have really cut into them with advertising and revenues and shit like that. Excuse me. But I think You might see CBS, Fox. There's going to be a lot of like acquisitions over the next couple of years, and that whole kind of media division of the stock market could just totally crumble compared to and fall into Netflix and stuff. I mean, everyone talks about Apple buying Netflix. What if Netflix is buying CBS and Fox and taking all their assets? You know, and it's something to think about.
Yeah, definitely.
Amazon, yes,
Yeah,
I might take
Jeff
it.
Bezos.
It's might take over the world.
Right.
You know what?
So, and so, yeah, we had the room until 6. So, is there anything else you want
No, I was gonna kinda look at Blue Apron, cause like I heard some people talking at UPS about some stuff. I don't know if I told you all of it.
to? Yeah.
They've been on the downtrend.
I glanced at the other day.
Since the IPO,
It's just like,
that's all.
From 75 to 3 bucks.
It's IPO. I don't know
Can
where
you
this
imagine
truck's
that?
from. I don't know where this truck's from, because its IPO was this year.
Yeah, it's like not even.
Yeah, I don't even think that's real.
so have y'all heard of Eat Fresh?
I have.
Yeah, we ship a lot of those boxes at UPS, and like the thing that interests me is I didn't really know why at first, and then some guy told me, he goes, well, you know, a lot of these people out in the country, they just order these services, and then they don't drive to the grocery store. So
Oh, that kind of makes sense.
I hadn't looked at the stock in a while, and I was kind of curious.
UPS is pretty cheap.
It took like a 10% hit.
Yeah.
I think it's still got like a 3% dividend.
So later this year, we'll get into fundamentals and we talk about how you can tell if a stock's cheap and what that actually means in certain spaces. So he's looking at PE ratios right now, price to earnings ratios, and it's one accounting ratio that you can use. There's multiple, but fundamental analysis will allow you to see if a stock is undervalued, overvalued, cheap, good buy, and that's kind of what it's good for. But fundamental is more for a long-term hold. So because you're looking at balance sheets, you're looking at monthly data coming in. So we'll touch more on that in the general meetings if you want to learn more about that.
It's definitely, I think, a strong place to look at when it comes to valuing stocks. I want to go with my last stock, and that would be Berkshire Hathaway.
How can you not love it?
She's beautiful.
Yeah, I saw something about some other company trying to copy his business model.
BlackRock.
BlackRock, that's what it was.
So they put in $10 billion and they're trying to copy it. They didn't hear me that.
More than that, yeah.
So that's like they're pretty much Goldman Sachs trying to get into that. It's like,
Because he's kind of a venture capitalist in a way.
what's his name? Larry Fink, I think, is who's the CEO of BlackRock. Yeah, Larry Fink. He's one of the industry leaders in like just giving like a good barometer of how the markets are doing and how the economy's doing.
You can close out all that.
Larry Fink, if you want to listen to anyone talk about the markets, I'd say Larry Fink, Carl Icahn, Warren Buffett, Jamie Dimon, that guy, he knows what he's doing. I mean, if you look at the bond that we were talking about back in 2016, after they raised interest rates, he put in, I forgot how much it was. I want to say 10 billion or 5 billion into JP Morgan stock, like the day that it bottomed, and it hasn't touched that level since. They call it the Jamie Dimon bottom. And I don't know, without his investment in Bank of in JP Morgan, I don't know if we would have seen a bottom there.
JP Morgan's had some real trouble. I heard that they were limited by the Fed. The Federal Reserve literally stepped in and said that you cannot grow for the next year. If I'm thinking it was JP, yeah, look at this. No, that's Berkshire Hathaway. Can you look?
Yeah.
I think it's JP. Yeah, banks got crushed today. Here, can you scroll over? Okay, it didn't have too bad.
I mean, it's definitely pulled back a little bit. I think the biggest pullbacks among the banks, it was Goldman Sachs and maybe Morgan Stanley.
Yeah.
Goldman's going to be good. This next 3 months, I mean, where Goldman makes their money is from trading, and where you see trading is volatility. And we've seen a very big spike in volatility. So if you want to go with the bank, I'd say Goldman's gonna have good earnings. You don't really need a good market for Goldman. But what I was trying to look at is that Jamie Dimon bottom back in 2016. Let's see. Right here. So if you look at a technical kind of thing here, is that like you don't really want the market to close below its recent low that it set, and that's typically a bad sign. And you saw that a full week after that. So that's really surprising that it really set a bottom there. That's something that surprised a lot of people. If you look at that, and that's the day that Jamie Dimon bought in. Let's see. February 11th. All right, so he bought 500,000 shares of stock on February 11th. That's right where he bought. Bought 500,000 shares on this day. The whole market hasn't touched that point since.
Yeah, that's pretty crazy.
And I mean,
Insider trading? I'm just kidding.
yeah, right.
Right.
I mean, that's
How do you
really
call it that one?
what it takes.
Precisely.
Precisely, exactly. That's a little sketchy, to be honest with you.
I mean, if you see Jamie Dimon come out and say, "I'm buying another 500,000 shares," put all your money in it. You know?
Yeah.
Man, I mean, that's crazy because when he did that, I was looking at it and I was saying, you know,
There's no way.
it's set a level here. You see that level? You draw a line through it, sets a level. I'm like, okay, it's closed below it. There's no way it recovers, you know.
Right.
And then he throws money at the market and it skyrockets.
Yeah.
You know?
All right, guys. Well, thanks for coming today. Really appreciate it. I hope you all had a good meeting. We might touch on cryptos. We'll see how the market does. We're meeting every week, so look forward to that.